Gold has always fascinated humankind. Its beauty and rarity made it valuable from the start. People used it for decoration and religious artifacts. Eventually, gold became a medium of exchange. It was durable, divisible, and easily recognizable. Before gold, people relied on bartering. This system was inefficient. It required a double coincidence of wants. Both parties had to agree on the value of the goods being exchanged. Gold provided a solution. It became a common measure of value. This made trading easier and more efficient. As trade expanded, carrying large amounts of gold became risky. This led to the development of early banking systems. People could deposit their gold with goldsmiths. In return, they received promissory notes. These notes acted as early forms of paper money. They were backed by the gold held in reserve. This system formed the foundation of gold banking. Goldsmiths became early bankers. They issued more notes than gold they held. This was the start of fractional reserve banking. It fueled economic activity but also introduced risks. The gold standard emerged as a way to formalize gold banking. Under this system, countries tied their currencies to a fixed amount of gold. This created fixed exchange rates between nations. It aimed to bring stability and predictability to international trade and finance. The gold standard gained prominence in the 19th century. This period saw significant economic growth and globalization. The gold standard is often credited with this prosperity. It provided price stability and encouraged international investment. However, the gold standard wasn't without its flaws. Economic growth depended on the supply of new gold. Discoveries of gold mines often led to inflationary booms. Conversely, limited gold supplies could cause deflation and economic downturns. The gold standard also limited governments' ability to manage their economies. They couldn't freely print money to stimulate growth or control inflation. This rigidity became increasingly problematic during times of economic stress. The 20th century brought new challenges to the gold standard. World War I disrupted trade and forced countries to abandon the gold standard. They needed to print money to finance their war efforts. After the war, attempts to return to the gold standard proved difficult and ultimately unsustainable. The Great Depression of the 1930s dealt a major blow to the gold standard. The economic turmoil and bank failures led to a loss of confidence in the system. Countries started to devalue their currencies or abandon the gold standard altogether. They sought more flexibility to address their domestic economic problems. The Bretton Woods Agreement of 1944 marked a turning point in international monetary policy. It established a new system with the US dollar as the reserve currency. The dollar was pegged to gold, and other currencies were pegged to the dollar. This system aimed to provide stability while allowing for more flexibility than the traditional gold standard. Section 4. The Fall of Gold. Why the system couldn't hold. The Bretton Woods system eventually faced its own challenges. The United States' growing trade deficit and the Vietnam War put pressure on the dollar. Speculators began to doubt the dollar's convertibility to gold at the fixed rate. In 1971, President Richard Nixon took the US dollar off the gold standard. This marked the end of the Bretton Woods system and ushered in an era of floating exchange rates. Currencies were now valued based on market forces, not on a fixed gold price. Several factors contributed to the demise of gold banking. The fixed nature of the system proved too rigid to accommodate the complexities of modern economies. Governments wanted more control over their monetary policies. The growth of international capital flows and speculation made it difficult to maintain fixed exchange rates. Section 5. Golden Echoes. Lessons from a bygone era. The gold standard and gold banking are relics of the past. However, their history offers valuable lessons for modern finance. The gold standard highlighted the importance of price stability and fiscal discipline. It showed how an international monetary system could promote trade and economic growth. The fall of gold banking taught us about the limitations of rigid systems. It demonstrated the need for flexibility and adaptability in a changing world. Modern central banks still grapple with the challenges of managing inflation and ensuring financial stability. While gold no longer backs our currencies, it retains a unique allure. People still view it as a safe haven asset. They turn to it during times of economic uncertainty. The history of gold banking serves as a reminder of the complexities and evolution of money and finance. It also reminds us that even seemingly unshakable systems can be vulnerable to change.